The U.S. economy is sleepwalking towards a major potential crisis, and it's got nothing to do with tariffs. In fact, this is far deeper than tariffs. So let's get started with exposing the huge issues that those in power really don't want you focusing on. Then we look at how you can protect your money and potentially even profit long-term while the American economy sleepwalks to that potential disaster. So the biggest issue? National debt. Guys, this is not new. It's something we talk about time and time again. And a lot of people would sit there and say, hey, we've increased our debt, it's gone up a ton, and we've been fine ever since. Fair enough. I get that. But just like in 06 and 07, the US had not seen a nationwide pullback in real estate values in the remembering history, doesn't mean it can't happen again. This is like the frog in the boiling pot. The water gets hotter and hotter and hotter, and the only time the frog notices is when it's finally too late. At the end of the day, guys, we have money coming in with our GDP, tax revenue. We have a growing economy, we have the strongest economy in the world as of right now. But guess what? If you keep on piling debt, it becomes an issue. Why? Well, very simple. The more debt we take on, the more interest payments we make. The more interest payments we make, the less revenue we can use towards infrastructure and things like that we really believe in growth. The more you borrow, you're taking away from the future and giving yourself today. But what are we borrowing for? We're borrowing for a lot of government BS. And of course, nobody in power that wants to do anything about it because they're in power for a reason. The more we rely on them to give us money, the more valuable they are to us. And the more money they give us means more debt. Guys, as cheesy as the site looks, this is all the debt we have. This is US GDP at keep growing. We're almost at $30 trillion in GDP. But guess what? Our national debt, $36.8 trillion. That's over 100%. That's a lot. Now, when rates are 0, 1, 2%, it's very easy. You're paying 1% on $36 trillion bucks or 2% in the short run. Who cares? $700 billion. But right now, our debt levels are over $1.2 trillion per year of money we spend. To give you an idea, we spend about $800, $900 billion a year on the military. We spend about $1.2 billion to $1.5 billion on Social Security. These are the things that money could be paying for. And again, I'm not a person that doesn't believe in taking on deficits, which is the yearly losses, but they have to be done at the right time. I believe in the old method. The old method was during good times, you build a surplus up, you save your money, and then when there are bad times, you use that money to go out to the economy. Does that sound familiar? It's exactly like you are as a person. The US government's like a human, and there's money coming in and money going out. And the more and more debt you take on, the more money that goes out when you don't have revenue coming in, it can be fine for a while. The example I always give was using your credit card to make your mortgage payment. That can work for a long time until it doesn't. And this thing is going to keep on going up and up and up. And I'm sure there's people out there who live in the US who have these billboards that are continuously showing the US national debt. It's crazy out there. Now, we have national debt for exactly the reasons I mentioned before. We have it because we had COVID. We had to write big checks to people, stay home, to keep the economy going. Great financial crisis. That's when deficits and debt should be used, in my opinion. It should be used to save us during a temporary bad problem. But unfortunately, that's not what's happened. Unfortunately, it's become this crutch that we use to get us through times. Oh, we want to buy this new shiny car, take on more debt because we don't have the money. It's no different for the government. Now, I will hear people say, it's impossible for us to pay off our debt. Well, no, it's not. It's not impossible. It's very easy, actually. You put one person in charge who's actually willing to do it, and they'll be very unpopular, and they'll be hated. But at the end of the day, it's cut big government programs, probably have to increase taxes temporarily. That way you can get a surplus going. In the last 45 years, we've only had a surplus for 2 years. And the reason we had that surplus was we had bigger growth than we thought. We definitely spent the money we thought we were going to spend, but the growth in the US economy in the late 90s was far greater than people thought, led by technology and the internet. If we were disciplined, if the people in Congress had the right motivation and incentives to do so, we'd be out of debt like that. When I say like that, we'd at least be in a surplus very quickly, and then over time, we'd pay down that debt. Just like when you have a house. Could we amortize this over 30 years, pay it off? Of course we could. We don't need to, by the way. If we amortize this over 100 years, that would be fine. The point is, we have the ability to pay off our debt. We choose not to. Now, here's what's interesting on this chart. Here's the U.S. federal debt to GDP ratio by year. It's gone down here. Then it started to go up, and now it's at 122%. Guys, when we were at war, we had to take on debt. We were coming off a Great Depression. We entered a world war, and then we had to take on debt to go out there and fight it. And guess what happened after? The economy went into a major boom. So we went from, I think we were pretty close to 100% debt ratio, if not higher, right after the war. And over time, the economy grew, and we were able to pay down that debt or keep it at a lower level as a percentage. We can still increase our debt as long as it's slower than the U.S. economy is growing. So the next question is, okay, what happens if U.S. debt doesn't get paid off? Well, again, if we can get to a point where we're just maintaining the debt, we're fine. If we were able to right now, if somebody came out right and said, Paul, we will never surpass this number ever again, I'd be like, oh, we're going to be great. Why? Because the U.S. economy is going to continue to grow. And in 20 years or 15 years, when our U.S. economy goes from $30 trillion in GDP to 60 or 70 trillion, we're back to 50% in terms of the debt to GDP ratio. And we're fine there, and it'll continue to go down as the U.S. economy gets bigger. Now, with that said, if all of a sudden the U.S. population started to sink, U.S. GDP would go down along with it. Even though GDP per capita could still go up, U.S. total GDP would go down, and the share of national debt, even if it stayed the same, would go up and up and up. Because if the population is declining, but the debt stays the same, you still have more per person in terms of debt. Now, that's if we just don't pay it off but maintain it. What happens if we keep going with it? Well, it's very simple, guys. This is what happens. If we keep increasing our debt at a faster rate than the economy, let me show you some quick math here. We currently have GDP, call it 30 trillion, and we currently have debt of 36 trillion. Very simple. And this is 2025. Let's go to 2050, 25 years from now. And let's say GDP grows at, this is nominal GDP, grows at 4% a year for 25 years. What is that growth? That would take our GDP to $80 trillion. That's a lot of money. Now, what about this debt? If the debt is 6% a year, just growing at 6% a year, and right now the debt's growing much higher than the 6% per year. At 6% per year, you're looking at roughly $2 trillion this year. But 25 years from now, 36 trillion becomes, ready for this one? $155 trillion. Guys, we're almost double at that point. Instead of being 122%, we're at 190 some percent. That's a problem. Now, if we're like Japan, where they have 200 some percent debt to GDP, but their interest rate on 10 years is 1.3%. Right now, ours is 4.2%. At let's call it 4%. Let's say in 25 years, it's 4%. That'd be $6.6 trillion per year in interest payments versus the 1.2 trillion we're doing right now. So even though GDP is only up to 2.6 times, our interest payments are up over 5x. That's a big difference. That is crippling. So it wouldn't happen today, but down the road, that would cause our debt levels to be so high that there's only a few ways in which to solve it. One, raise taxes. I'm going to get into the repercussions of that one, but we have to raise taxes, especially on the wealthy. Two, we have to cut spending. Or three, a combination of both. Now, those are the things that we can do. We can go to Congress come out there and say, taxes are raised, spending is cut. What we can't really do, especially we can't really control as easily, is if we have a long period of amazing growth. All of a sudden, GDP grows so much higher than we expect. Instead of 4% per year, it grows at 8% per year for the next 25 years. Do me a favor. Show me in an economy that is worried about population growth where GDP can grow at 8% per year. Let me show you this. From 1975 to 2000, we were in the middle of an oil crisis. We had stagflation. Things were not good here. Until 2000, a booming economy. GDP growth was 7.5% a year. Population growth was 1 to 1.5% a year. Big time growth. That's how we got such big growth. Now, the start of basically the internet and tech boom to today, we've had 4.5% growth. with still population growth around 1% per year. So do you see why I'm worried about a 25-year period of 8%? That won't happen. That's very unlikely to happen. And that's the problem we have here. Now, I mentioned taxing rich people, and I'm sure a lot of people watching this video going, that's fine by me, tax them, they have too much. Fair enough. Let's assume that is correct. Now, the one thing I also hear from people who say those things are the rich are greedy. Fair enough. I'll give you both those. I'll sit there and say tax the rich because they can afford it and the rich are greedy. Now, let me ask you a question. Put yourself in that greedy, rich asshole's shoes and say, hey, you made a lot of money and you're still making a lot of money. But instead of us sitting there giving you incentives to do more, we're going to raise your taxes. How high? I don't know. But in 1960, the highest tax rate was 92%. I said that right, guys. 92%. Today, it's what, 37 to 40%? Something like that. 92%. That means for every dollar of profit that a rich person made at a certain level, they got 8 cents of it. You're not rich. You're not the greedy asshole out there. Would you work for 8 cents in your pocket for every dollar you made? And you're not even the greedy one. You're the one that's not greedy. If somebody who's rich is the greedy person, I'm the greedy person, you're going to tell me I'm going to go start a business, risk all my capital to make 8 cents? What's I have to say to that? No effing way. I would shut everything down and say, I got enough. I'll just go move to another country, take all my assets there and live a great life and avoid all that mess. Why would I ever go invest in the economy, in anything at these kind of rates? You might sit there and say, well, Paul, 92% is insane. Well, let me remind you, in 1913, 47 years before this date, the income tax rate was 7% on every dollar above what would be $13 million today. In a 47-year period, we went from 7% on every dollar above $13 million to 92% on every dollar above, I think it was equivalent to like $1 million, some lot lower number than this. And this is inflation adjusted. So for those of you who don't think that 92% would happen again, we are way higher than this right now. So it's just a matter of crisis. And don't forget, it's much easier for politicians to go, you're doing poorly because some other rich guy is making a lot of money. Fine, do it. Go read the book Atlas Shrugged. At some point, the people who create jobs will say, I'm not going to do it anymore. You go look at a guy like Jeff Bezos. Does he have too much money? That's subjective. I will tell you one thing. We don't have Amazon. If you told Jeff Bezos every dollar above 100 million he can't have anymore, he'd be like, well, then why take the risk? Why would he even take? Because guess what? For every Jeff Bezos out there, there's 1,000, 2,000, 3,000, 5,000 that tried that didn't get it. All those venture capitalists out there, they always say, I need to have my 100x growth in order to make all my bad investments. Well, if all of a sudden the 100x is capped to 5x, it makes no sense for them to ever invest in these startups that can make a lot of money and make a lot of jobs. And don't forget, yes, Jeff Bezos is worth a couple $100 billion, but he also employs 1.5 million people, and that's a lot. And if you don't hear what I'm saying, I'm going to be very, very black or white about this. If what I'm saying to you still sounds to you like, yeah, tax them more, you are stupid. Then you've never, ever been on you will be on the receiving end of of the government's wrath at some point. You just don't realize it yet. All of a sudden, one day you'll wake up and it might not be taxes, but it'll be something else. And this is my concern. The more debt we take on, as much as it sounds like politics, it's just human nature. The more debt we take on, the more we have to tax people, it will affect everybody down the line. Because if the rich people get taxed, they invest less. If they invest less, they create less jobs. If they create less jobs, middle class, the poor have less opportunities. There's less innovation. 100 years ago to today, a poor person is a lot more wealthy today than they were 100 years ago, just in terms of lifestyle. That doesn't happen if we have high levels of debt relative to GDP. It's a trickle-down effect, as much as people hate hearing that. But that's the absolute fact of it. Now, how does this affect the stock market? Because this all works in the stock market. Guys, higher taxes lead to less profit, less reinvestment, less consumers out there buying more stuff. You see the trickle-down effect into that as well. It is going to affect the stock market greatly. Now, what I'm going to say next, I will dive deeper into in a later video, coming out very soon. But for right now, the more debt we take on, the more risky our country looks. The more risky our country looks, the less likely other countries are to buy our debt, which is kind of starting to take shape right now. And then when there's less attractiveness for people to buy our debt, what do we have to do? We have to raise our interest rates to make it more attractive. If we raise our interest rates, what happens to our interest costs? They go up. What happens to our deficits? They go up. We're back to the square one of we have to raise taxes, cut spending, some combination of both. Guys, the debt levels are serious. Are they serious right now in terms of where we are? Yeah, they're a little serious now. Are they manageable? They're manageable. At some point, they will not be manageable. Look at the state of California. Look how many people are leaving there because of the cost of living, the high taxes, etc. But then when you have companies leaving California like crazy and going to better states that are more pro-business, how is that any different than what we have going on a national level? But the great news is, if stocks do start to fall from these levels and we get major opportunities, there's a way to get higher return on your cash than relying on the US government to pay you through treasuries or that paltry 0.43% savings rate that your bank is offering you right now. There's a way, it's called selling cash secured puts. It's a way of making 10 or 15% interest on the money that's cash in your accounts. Now, it's not a guarantee, but it's a way of buying stocks you want at a lower price. You have to be disciplined about it. If you're interested in that, if that sounds interesting to you, May 15th, we have a wonderful class we're doing that will explain this in full detail, how I've been doing this for the last 5 years. It's a way of making double-digit returns on the cash in your account. Click the link below, sign up. I guarantee you that if you follow the process, you will be able to do much better with the cash in your account than you're doing putting it in a savings account, making that paltry interest rate. And the worst case in that situation is you get stock at the price that you want. But the understanding part is, what's the price you want? Is it the right price? So again, click that link, check it out. It's for serious investors who want to make a premium. Thank you for your time.